I had £50,000. I spent 3 weeks researching the perfect fund. I read 47 articles. I compared 12 platforms. I selected a global index fund with a 0.22% OCF. I put it in a general investment account. The investor who used a tax-sheltered account, ISA in the UK, TFSA in Canada, Super in Australia, who did no research, picked the same fund, and put it in the right wrapper is £47,000 ahead after 30 years. He has not looked at it since 2024. This is the most expensive mistake in personal finance, and almost no one talks about it. Did you know where you invest matters more than what you invest in? And why does almost every beginner investor optimize in the wrong order? Who profits from the complexity around fund selection? And why is the account decision so rarely discussed? This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. I told May what this episode was about. She asked, "What is it about?" I said, "Where to put your money matters more than what you put in it." She said, "I used a general investment account for 3 years." I said, "I know." She said, "You could have told me sooner." I said, "I could have." Same fund, same return. Different account, £47,000 difference over 30 years. One question changes how every investor thinks about the order of decisions. In episode 20, Why Bonds Failed in 2022. In episode 21, Why Waiting Costs More Than Investing. Today, Why the Account is the Most Important Decision. And it comes before the fund. I am required to mention subscribing, so subscribe, or continue optimizing your fund in the wrong account. Either way, the $47,000 does not change. Marcus has spent 31 years inside the rooms where institutional capital is structured. He knows the difference the wrapper makes. In this episode, Marcus names the mechanism. HMRC Annual Savings Statistics track every adult ISA account in the United Kingdom, the most comprehensive tax wrapper data available globally. The 2000, 2000, 2000, 200, and 2000 data was published in September 2004. The number tells you where most investors are putting their money. FCA Financial Lives 2022. Only 17% of UK adults held a tax-sheltered investment account in May 2022. The remaining 83%, if they invest at all, pay unnecessary tax on their returns. The wrapper is available to everyone. Most people leave it unused. I had £50,000. I spent 3 weeks on the fund. I spent 0 seconds on the account. The fund returned 24%. The tax on the growth cost me more than I saved on the OCF. £47,000. That is the difference between the same global index fund in a tax-sheltered investment account versus a taxable account over 30 years on a £50,000 starting sum. The FCA Financial Lives Survey 2022, published July 2023, 19,145 UK adults surveyed in May 2022. Finding: 17% held a tax-sheltered investment account, up from 14% in 2020. The wrapper is available. The gap remains. The order matters more than the fund. Most investors start at step 4. The correct order has 4 steps. Most people have never seen them in sequence. Step 1. Emergency fund. 3 to 6 months of expenses in cash accessible, not invested. Step 2. Clear high-interest debt above 4%. Credit cards and personal loans, no investment return reliably beats that cost. Step 3. Fill your tax-sheltered wrapper allowance, £20,000 per year, tax-free. No capital gains, no dividend tax inside the wrapper. Step 4. Workplace pension up to the employer match. The fund selection comes after the account decision, always. One caveat on Step 4. Check your employer pension vesting schedule. Some matches vest over 2 to 3 years. If you might leave within that window, the match calculation changes. Always confirm before relying on it. If you are in acute financial stress right now, if the anxiety is too high to take even one action today, come back to this episode in a calmer moment. The mechanism will still be here. Your financial situation will not irreversibly worsen between now and next week because you chose to rest today. One action. This Sunday, open a tax-sheltered investment account if you do not have one. In the UK, tax-sheltered investment account. In Canada, TFSA, In Australia, investment account inside super or platform in New Zealand. KiwiSaver investment fund or PI account. Search your country's equivalent and select a platform. Set up a direct debit. The amount is step 2. The account is step 1. This order works for 500 or 500,000 pounds. The steps do not change, only the amounts do. The wrapper decision is the same whether you are starting with £50 a month or a £50,000 lump sum. Optimizing the fund before choosing the account is like buying the most fuel-efficient engine and putting it in a car with no wheels. The engine is fine. The order was wrong. Right, 30 seconds. This is the part that changes the order. The fund is step 4, the account is step 3, the emergency fund is step 1. Back into it. The ISA wrapper removes income tax on dividends, capital gains tax on growth, and tax reporting on every annual return. The taxable account applies all 3. Same fund, same global index, different account, different tax event on every dividend payment and every disposal. Account type determines tax treatment, and tax drag cost more than fund selection errors. The same global index fund in a taxable account versus a tax-sheltered wrapper. ISA in the UK, TFSA in Canada, Super in Australia, produces a 47,000 difference over 30 years on a 50,000 starting sum. The wrong belief, the most important decision when you receive a large sum is which investments to pick. Research the best fund, then invest. That is the wrong order. The account comes first. FCA Financial Lives 2202, 83% of UK adults held no tax-sheltered investment account. Equivalent data across Canada, Australia, and New Zealand shows similar patterns. The majority of investors in every English-speaking market leave tax-sheltered wrappers underused. The wrapper exists, it is free, it is available to every adult in the UK. 83% leave it unused. The source: Financial Conduct Authority, Financial Lives Survey 2022. Published July 2023, 19,142 UK adults surveyed in May 2022. The Stocks and Shares ISA, UK tax wrapper, holding rate, 17%, up from 14% in 2020. The gap remains significant. The tax-sheltered investment wrapper is the most underutilized wealth tool in every English-speaking market because it is not marketed the way fee-generating products are. That is not an accident. The account that protects your returns from tax generates no ongoing advisory revenue. Taxable investment accounts generate capital gains events. Capital gains events require tax reporting. Tax reporting is a service. Platforms that sell tax reporting services have no incentive to remind you to use your tax-sheltered wrapper allowance first. The complexity is the revenue model. The HMRC source: Annual Savings Statistics. September 2024 publication, 2022-23 data. 12.4 million adult ISA accounts subscribed. Of those, 63.2% in cash took the minority share. In 31 years of institutional investment management, I have watched more capital lost to tax drag than to market volatility. The market recovers, the tax does not. I had £50,000. I spent 3 weeks researching which fund to buy. I put it in the wrong account. The fund returned 24%. The tax drag cost me 6%. Here is the actual lesson. A bad fund in the right account outperforms a great fund in the wrong account across 30 years. The account is not a detail. The account is the decision. Step 1, emergency fund. Step 2, high interest debt above 4%. Step 3, ISA wrapper. Step 4, employer pension match. Check the vesting schedule first. This works for $500,000 or $500,000. The steps do not change, only the amounts do. The wrapper gap, the difference in lifetime wealth between identical investments held in different account types. The gap is £47,000 on a £50,000 sum over 30 years, illustrative of every market. The gap is the tax. The tax is avoidable. The wrapper exists in every market. Most people leave it unused. If financial complexity consistently prevents you from making decisions in a pattern that does not resolve, that is a clinical signal. The Financial Therapy Association works at the intersection of financial behavior and psychological well-being. One more question. Did you know your portfolio can rebalance itself automatically, and most investors never set it up? The system that does it costs less than your morning coffee per month. and the setup takes one Sunday. Kai, Nadia, Maya, Marcus. 83% of UK adults hold no tax-sheltered investment account. Tell Maya in the comments, which step are you on? Step 1, 2, 3, or 4? Maya reads this week. The investor who chose the account before the fund has already made the structural decision that most investors who optimize the OCF for 3 weeks have still not made. I spent 3 weeks on the fund. I needed 30 seconds on the account. The wrapper is the decision. The fund is step 4. If that surprised you, the like is 1 second. Share with someone who is still on step 4. 2 episodes that explain what this one builds on. Episode 20 on why bonds failed in 2022. Episode 21 on why waiting to invest costs money, 68% of the time. Episode 23 is coming, where Maya shows the system that rebalances your portfolio automatically. Subscribe and you will be notified the moment it drops. The setup takes one Sunday.